You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Welcome to this investment roadmap, day 4, stock analysis made easy. Of course, there is a lot of content in this podcast series. Doing this like 10 minutes at a time, like stock analysis in 10 minutes, kind of crazy, right? But what I want to tell you here is I'm a big fan of the Pareto Principle. So Pareto Principle is 80% of the result will be generated by 20% of effort. So the point here is to focus on that 20% that is like super important, and then you're going to get most of the result that you should get. That is actually valid pretty much on everything. And I've like this principle has been driving most of my life actually, and it works well. So this process is not perfect, of course, but it covers so much ground in an efficient way. And between you and me, efficiency beats complexity at every single time. So if you want to get more though, I do have a resource for you. You can download the complete investment roadmap at DSR. So dividendstocksrock.com/roadmap. You put there your email, you're going to receive the roadmap completely explained. So it's going to be a great complement to this podcast series. So today, how can we analyze a stock in literally 9 minutes now left to this podcast? So number one, you must understand the business model. So we have looked at the numbers before. Now it's time to write down your investment thesis. What's your investment thesis? Well, this is like all the reasons why you like a stock. And to do that, you must understand the business model. So you're shaping the story that is backed by the numbers. The way we do it at Dividend Stocks Rock is we separated the investment thesis in 3 sections to make it easier to understand. So the first one is the playbook. So what's the company playbook is how the company makes money, literally. Like what's the way that business is generating income? Are they like selling iPhones? Are they renting apartments and they're an apartment REITs? Like it's just their playbook, how they work. Then you identify the growth vectors. So the growth vectors is all the ways that business will be able to increase their revenue in time. So growth by acquisition, innovation, strong business model, getting like a lot of like people to consume their products and so on. So all the possibilities that this business is going to increase their sales. And finally, after highlighting the playbook and the growth vectors, you want to see if the company has any competitive advantage known as Moat. So is the business as a monopoly or operates in an oligopoly? That would be great. High barrier to entry, such as like railroads, for example, or benefiting from like huge network effect like Meta. Pretty hard today to build a social media stronger and better than Facebook now that Facebook has been around for so long, right? So those are like the competitive advantage, the moat. So that's the first one. Once you understand the business model and you have written down your investment thesis and you get all excited, well, now you have time to go back to earth and look at the risks. Risks are important. You need to know what could go wrong for a company so you can understand how to react whenever it happens. So at DSR, we split the risk in 3 different categories. So this is how we like write our stock cards. So at the beginning, we talk about highlighting the business flaws. So the business model is great, but of course, there are like some things that are not going to be that great. For example, National Bank, great business model, but the fact that they're heavily exposed to the province of Quebec, la belle province, well, that's 50% of their revenue. So that is a business flaw. If there's something wrong in this province, and the economy, National Bank's going to take a big hit. So it's important to understand that. Then you have the industry and the market threats. So exterior threats to the business, stuff that you cannot manage or you cannot control. So regulators for pipelines, for example, well, there's nothing that pipeline operators can do. If regulators says, well, we are not going to let you build a new pipeline, well, that's pretty much the end of the story. So this is how industry market threats could impact the business. And finally, you make a list of competitors. It could be competitors in a sense that how they how the company that you're about to select can outperform those competitors, or on the other way around, making a list of competitors will also open your eyes on what is what are the other options I can invest my money in. So maybe I did not select the right pipeline. Maybe I did not select the right grocery stores. Maybe I really like Metro, but I realized that Loblaws is better, like better number or better business model for whatever reason. So it gives you like a little bit more option. So now we have our investment thesis, all the positive narrative. Now we also added the potential risks. So all the bad things that could happen. What's left? Well, super important, dividend growth perspective. So at DSR, we want to know if the company has the ability to keep increasing its dividend. So the first thing is to look at recent history, right? So you want to look at for how many years the company has increased it consecutively. The second thing is, what's the trend? Is it like always about the same increase? Like Fortis, it has been increasing its dividend like 5-6% per year for like 50 years. Kind of crazy, super clockwork. Some companies are not that stable. Sometimes it's going to be like 7%, then 3%. So if there's a slowdown, that could be a red flag. You're going to look at the payout ratios. So adding a little bit more numbers to your narrative here. And the point here is to look at the complete list of metrics and graph around dividend growth trend. So the dividend growth trend over the past 1, 3, 5, 10 years, the payout ratios, the yield trend. So making sure the business has a solid dividend triangle so it will continue to increase its dividend. So this part is super important for me, maybe not for you, but it depends on your strategy. Finally, now we have a pretty solid narrative that has been written up in the investment thesis. We know about the risk. We know about where the dividend will go. So the next and the final step will go to be to do additional research when it's required. So when should you go doing a deep dive on something? Well, you should do that whenever you see a metric in the dividend triangle, so either revenue, earnings, or dividend, that goes up too fast or goes down too fast. So when there is something in the trend that tells you, oh, something happened over here, so then you need to go into that quarter and start researching. Another red flag where you need more investigation is if you look at the debt level. So at DSR, we have the long-term debt graph over the past 10 years. If it keeps going up all the time, well, that's going to be a problem at one point because you cannot just keep on racking up debt and not paying it, right? So yes, it's great to borrow money to grow the business, but at one point it has to stop. So you'll have to dig a little bit deeper on this one. Valuation, of course, a lot of people are a big fan of that. I'm not too much of a fan of valuation. I prefer to, yes, look at the current PE ratio, the forward PE ratio versus the average over the past 5 and 10 years to see if where the company is standing there in terms of PE ratio. And I do that for the yield as well. So the average yield versus the current yield. So it tells me what the market thinks of my potential new purchase. In my opinion, too many investors hide behind the word, oh, it's overpriced, I'm going to stay on the sideline. Yeah, well, if I had listened to all those investors for the past 10 years, I would have missed on Visa, on Costco, on Constellation Software, on Apple, on Microsoft, on National Bank, on Couche-Tard. Pretty much all the companies that are triple-digit return in my portfolio. Kind of ironic, but this is what it is, right? So overpriced, yes, you want to buy at the right value, but don't go crazy on that because you know what? Your valuation method is just as good as your crystal ball. and your crystal ball, I don't know, like mine, pretty blurry. Maybe yours is impeccable, but that's not that's not my case. So finally, additional research is also required if any other metrics looks off, like free cash flow, cash flow from operation, like anything that you look at and it's like, well, there's a problem here. Well, then you go into that quarter, you read the quarterly statement, you read the investor's presentation, and you need to do a little bit more of a deep dive. Actually, I explain this and I explain how to analyze stocks a lot more in the DSR investment roadmap that you can download for free at dividendstocksrock.com/roadmap. It's going to be a great complement to this podcast series that will continue next Monday. So for tomorrow, we're going back to Retirement Friday. We're going to talk about how much cash is too much in retirement. Sorry, Moose, that's enough for today. Do not forget to download the investment roadmap at dividendstocksrock.com/roadmap. And we're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.